Hello, everyone. Welcome. We'll give everyone a few minutes to join. While we're waiting, we'll all comment our favourite Taylor Swift song in the chat. I mean, you can if you want, but you don't have to. Hope everyone's well. Cool. We'll just give it another minute. Oh, thanks, Rebecca.
You're welcome.
Oh, Chloe, nice choice. Thanks. I'm loving this. We could just do this for an hour. I'm fine with that. Thanks, everyone.
I think you should give a lyric for each of the songs so we know that you're a true
Might get in trouble if it might be here a while. So we'll get started. So just make sure we've got the chat there, and let's get started then. Good afternoon, everyone, and welcome to our end of year power hour. My name's Kay, and I'll be guiding you through some of the key dates and tasks you need to know at year end. So payroll year end can sometimes seem like a complex process with final submissions, reporting employee benefits, and then also preparing for the legislative changes in the new tax year. Ensuring everything is wrapped up correctly, and it's crucial to stay in compliant and avoiding those issues further down the line. Today, we're going to talk you through some of the key tasks that you need to complete, HMRC deadlines, and upcoming payroll legislation changes that could impact your business. So first of all, let me introduce myself. If you haven't met me or you haven't attended one of our power hours before, I'm Kay, and at PayFit, I'm part of the CCR team. So I help our customers with the PayFit app, as well as answering legislation questions. And I also support various projects across the business, including this power hour. So you'll have noticed we've also got the fantastic Rebecca here, and I'll hand over to her to introduce herself.
Thank you, and good afternoon, everyone. I'm Rebecca, the Product Legal and Compliance Specialist here at PayFit. It's a pleasure to be here hosting this webinar with Kay, my partner in crime. At PayFit, I work closely with our product builders to ensure our software is 100% compliant and make it nearly impossible not to be. Compliance isn't just my job, though, it's my passion. I love breaking down complex legislation and sharing it with our team, software developers, and anyone who will listen. Today, I'm excited to share the key legislative changes that will impact payroll in the upcoming tax year. I hope you'll find them as exciting as I do. Thank you for being here. I'm going to pass back to Kate to give us an overview of what we'll cover.
Thanks, Rebecca. So just before I move on, as well as ourselves, you do have Akash, who is our CCR team lead and is bursting with knowledge, ready to answer your questions in the live chat. So please keep him busy. Now, we don't have a photo of him, but as I've said before, you can picture him as the Wizard of Oz behind the curtain, only with fewer smoke machines and a few more tax codes. At the end, we'll also have a live Q&A for any questions we haven't been able to answer, as well as cover the pre-submitted questions that you've sent in for us. So as always, our power hour will be recorded. So if you want to go back over anything or we get a little bit too pet, you can put the Geordie translator tool on, pop those subtitles on the bottom and watch it back. So here's a quick look at what we'll cover today. We're going to take you through the end of year tax process, including finishing the 2024-2025 tax year. We are going to cover tax and NI changes. We'll also cover the increased statutory payment rates and changes to employment allowance and small employers relief. We'll discuss company cars and other benefits. And we'll dive into the new statutory neonatal care and leave and pay. So now I'm going to hand over to Rebecca.
Okay, now we have a quick poll for our wonderful audience. In the bottom right, you'll need to click on either apps and polls or just polls. And in there, you'll see we are asking, how much homework have you done on the legislation changes? So your options are, my dog ate my homework, or I've seen a few things on LinkedIn, I've been reading some of the HMRC pages, or I devour the legislation for breakfast. Let's see how you've been getting on.
It's very mixed, isn't it? Oh, looks like we've got a bit of a lead there. It's interesting.
That's good. I like that some people did vote to say my dog ate my homework.
Fab. Yeah, so I think it's settling down there now. So looks like most people have sort of read some HMRC payments, and some people may have not seen anything at all because it is a lot to take in, isn't it? So,
yeah.
Perfect. So, year-end tasks and deadlines. There are some key deadlines to keep in mind when it comes to tax year end. So I'll walk you through those along with some best practices to make sure that you're compliant and you're prepared. First, let's talk about finalising your payroll for the tax year. Your last full payment submission, or FPS, needs to be sent on or before your employee's final payday of the tax year. If you make any corrections after that, you'll need to submit a year-to-date FPS. And a reminder, your FPS deadline is still your payday, even for the last one of the year. You'll also need to submit an employer payment summary, or an EPS, if you're reclaiming things like statutory payments or you've got anything like CIS deductions. If you're not due to pay anything for a particular month, you need to make sure that you send a nil EPS so HMRC doesn't expect a payment from you. Your deadline for your EPS for month 12 is the 19th of April. It's important to note that your final indicator will need to be on your FPS if you are not sending an EPS for that month. Next, your P60s. So these need to be given to all employees who were still employed on the 5th of April. If anyone left throughout the tax year, they will not receive a P60, but they will have received a P45, which includes their year-to-date earnings anyway. The deadline for this and for issuing them is the 31st of May, so make sure that you've got everything in place to generate and distribute them in good time. And if your payroll software does this for you, just make sure you check the settings to make sure that they're being processed correctly as well. It's a good idea to review your payroll reports before you run April's payroll, and that helps catch any errors early and ensures a smooth transition into the new tax year. So checking things like tax codes, national insurance category letters, and pension contributions now can save headaches later on down the line. Just a little bit of a spoiler for what we'll mention later, but for the 2025-2026 tax year, the personal allowance and emergency tax code are going to remain the same at £12,570 and 1257L. And that means that you don't need to do any updates on employee tax codes by default, but you will need to remove those week one, month one flags. You might still get some tax notices between now and then for individuals that you need to action from the 6th of April. So it's important to keep a note of those so that you can action them. Just a quick note, Rebecca will touch on this later on, but PayFit does do those things automatically if you are using the software. And looking ahead to the new tax year, you need to make sure that you're aware of any changes to legislation that is going to impact payroll. This is the biggie. So you can tick that one off the list after this webinar. So congratulations there, you're already ahead. So keeping an eye on these changes, it's going to help ensure compliance and avoid any surprises. So if you're processing benefits through payroll as well, don't forget about P11Ds and the deadline for that submission, which is the 6th of July. Finally, a quick reminder on payroll best practices. You might already be doing this, but regularly reconciling your payroll figures against HMRC liabilities, keeping accurate records and staying on top of those deadlines is going to make your end of year process much easier. If you do run into issues, HMRC's guidance is a great resource, and your payroll software provider might also be able to help. Again, if you're using PayFit, you can reach out to us. And now I'll hand back over to Rebecca.
Thank you. Now for the main event, Kay and I are going to take you through the legislation changes for the 2025-2026 tax year. Let's start with national minimum wage. Here you can see the increased hourly rates. So for workers aged 21 and over, it's now £12.21. For workers aged between 18 and 20, it's £10 an hour. And for apprentices or workers under 18, it's £7.55. You might notice that the gap between the age bands is decreasing, and that's because the government plans to remove age discriminatory wage bands altogether. They're moving towards a single rate for all workers regardless of their age. Now back to Kay.
Thank you. So next, let's take a look at everyone's favourite topic, which is tax. So for the 2025-2026 year, there are no changes to income tax rates or thresholds in England, Wales and Northern Ireland. The UK-wide personal allowance, as I said, remains frozen at £12,570. Now, this means that more individuals may now move into the higher tax bands as wages rise with inflation. For the 25-26 tax year, some of Scotland's tax thresholds are changing. So the starter rate threshold increases to £15,397, and the basic rate threshold rises to £27,491, meaning the basic and intermediate tax thresholds are increasing by 3.5%. These apply from your first payday on or after the 6th of April 2025, and all other thresholds remain unchanged. The rates are not changing, and the personal allowance is the same as the rest of the UK, which, as I said, remains unchanged. While I'm discussing the difference for Scottish tax thresholds, I just want to mention Scottish arrestment orders. So as of April 2025, the Diligence Against Earnings Variation Scotland Regulations 2024, try saying that 3 times fast, introduced changes to earnings arrestment orders, so the Scottish arrestment orders in Scotland, basically. There's a new protected minimum amount, and the threshold below which earnings cannot be arrested has been increased. And that's been done to try and offer greater financial protection to individuals in debt. The deduction bands have also been slightly adjusted, and that means that the income brackets determining deduction rates have been slightly modified, affecting the amounts deducted from earnings above the protected minimum. So it's, like I said, it's there to try and offer greater financial protection to those individuals that are in debt in Scotland. So just before we have a look at national insurance, I'm just going to check the chat and make sure that you're all keeping Akash busy. So yeah, it looks like Akash is busy in there answering questions, so we'll leave that with him for now. So let's have a look at national insurance thresholds. For the 25-26 tax year, the lower earnings limit, the LEL, is increasing, which could impact eligibility for statutory payments. So that's going to £542 a month. Meanwhile, the secondary threshold, ST, for national insurance is decreasing to £417 a month, meaning some employers may now see a higher amount of NI contributions. And we're going to switch back over to Rebecca now.
Thank you. Now let's look at the rates, starting with primary Class 1 national insurance, which is the employee contributions through the payroll. So the good news is there are no changes to these rates. For standard workers in categories A, F, H, M, N, and V, they continue to contribute 8% on earnings between the primary threshold and the upper earnings limit, and then 2% on any earnings above that. Married women and widows with a certificate of election, which is categories B, E, and I, still pay a reduced rate of 1.85% between the primary threshold and the upper earnings limit, and then 2% on any earnings above. Workers over state pension age remain exempt from national insurance altogether, and those who can defer national insurance because they're already contributing via another job, so categories D, J, L, and Z, pay 2% on all earnings over the primary threshold. So in summary, nothing changes here. Your Class 1 employee NI contributions stay the same. Now let's take a look at secondary Class 1 national insurance contributions, which is the employer's version of the contributions that are going through the payroll. So this is a really significant change. Everything is increasing from 13.8% to 15%. So for standard NI categories, employers will pay 15% Class 1 national insurance on any earnings over the secondary threshold. For workers in specialist tax sites, which is free ports and investment zones, the 15% applies to any earnings over the free port or investment zone upper secondary thresholds. And for apprentices, veterans, and workers under 21, it's 15% on any earnings above the upper secondary threshold. As Kay explained earlier, the secondary threshold has decreased, so it means it's a double whammy for employers. They now pay national insurance on more earnings and at a higher rate. On top of that, the Class 1A and Class 1B rates, which cover benefits in kind and termination or sporting testimonial payments, have also increased to 15%. So these changes significantly increase the overall national insurance cost for employers, making payroll planning even more important. Back to you, Kay.
Thank you. So next, I want to talk about employment allowance and the apprenticeship levy. So firstly, employment allowance is designed to help eligible employers by reducing their annual secondary Class 1 national insurance bill. So secondary Class 1 NI, national insurance, is the employer's portion of national insurance, which is calculated through payroll. So currently businesses can claim up to £5,000 per tax year, but from April 2025, this is going to more than double to £10,500, which will provide even greater relief to employers. So right now, businesses with a secondary Class 1 NI liability over £100,000 can't claim the allowance, But from the 6th of April 2025, that restriction is going to be scrapped altogether. And that means that employment allowance is going to be available to all eligible businesses and charities, regardless of their NI contributions in the previous year. So although we see a rise in what employers will pay for their secondary Class 1 NI, as we just mentioned, this increase in the employment allowance and the removal of that restriction means that that's going to help employers offset some of those costs. According to the autumn budget, these changes mean that around about 865,000 employers will pay no NICs at all in 2025, which is obviously going to be a massive boost for businesses. So who can't claim? The people who can't claim, the businesses that can't claim, are businesses that carry out more than 50% of their work in the public sector. So, for example, you've got local councils and NHS services, unless they are a charity. Companies with only one director and no other employees liable for secondary Class 1 NICs. So yeah, there's some changes there which I think are quite positive for businesses. So. And now I'll touch on apprenticeship levy. So in 2024, the government announced some changes to the apprenticeship levy. There are plans to rename it the Growth and Skills Levy, and they are backing it with £40 million to make training more accessible for businesses of all sizes. So right now, employers pay 0.5% of their annual pay bill towards the levy, which applies to all earnings subject to Class 1 secondary NI contributions, even those below the secondary threshold. However, the £15,000 annual allowance is not changing, so companies can still use that against their apprenticeship levy. And I'll hand back over to Rebecca.
Thank you. As I mentioned earlier, for employers in a designated specialist tax site, so Freeport or investment zone, they start to pay national insurance contributions once workers are paid above a much higher threshold for their eligible workers, which is £25,000 as opposed to £5,000 a year. So from April 2026, for those eligible workers, you need to include their workplace postcode in your full payment submission. HMRC can use that postcode to verify that the worker is based in a designated specialist tax site. So that might be, your workers might be in a Freeport, they'll be using NI categories F, I, L, or S, or in an investment zone using NI categories N, E, K, or D. The postcode must reflect where the worker spends at least 60% of their working time. It's important to know that the workplace postcode is reported for the eligible workers on an individual basis. For example, if you have two sites, you have employee A working at site 1, so you need to report their workplace postcode as site 1. Employee B works at site 2, so you need to report their workplace postcode as site 2. You should start gathering the postcodes now because you won't be able to send your FPS in April without it. Okay.
Thank you. So now, before I dive into student loan, I'm just going to check the chat, and yeah, it looks like everyone is keeping Akash nice and busy.
Do you want to cover the question from Christopher on Scottish tax?
Let's have a look. How does it work if people live in Scotland and come to our office in Newcastle and work there most of the time? Not a problem, but you have a potential. Yeah, so a really good question there, Christopher. If you've got employees who, it's based on where they live, so it's based on their home. What we would always say is go with your basic, if they've got a starter declaration form, that's what I'm looking for, or their P45, you're going to be using those details for their tax code. And HMRC will send you an update if that needs to change. So if, say, for example, they've lived in Scotland for more than half of the year and then they move to England, HMRC will update that tax code for you. They'll send you the notice to say it needs to be an S at the start. But yeah, it's based on where they live. So that's what we're looking at there. Thanks. So yeah, we'll have a look at student loan now. So the government has confirmed changes to student loan repayment thresholds, meaning borrowers on Plan 1, 2 and 4 will see an increase in the income level before repayments begin. The postgraduate loan threshold, however, remains unchanged at £21,000. And these adjustments affect employees repaying through PAYE and self-employed individuals completing self-assessments, as they impact how much is deducted from earnings. So in simple terms, if you're on a student loan plan, you may see a reduction in repayments, especially if your income is close to last year's threshold. So for example, say you're on Plan 4 and you earn £34,000 a year. Under the previous threshold, your annual repayment would have been £234, and with the new threshold, it's going to drop to £113. So that's cutting repayments in half, and it's going to leave employees with more disposable income. And I'll just hand over to Rebecca.
Thank you. Okay, so we're going to move on to statutory payments. And I'm sorry I'm passing back to you, Kate, to tell us about the statutory payment rates.
Keeping everyone on their toes. You don't know who's going to. So for the 25-26 tax year, several statutory payment rates are increasing. So firstly, we've got statutory sick pay, SSP, that is going to rise to £118.75 per week, effective from the 6th of April 2025. Statutory parental payments covering maternity, paternity, adoption, shared parental and parental bereavement leave will increase to £187.18 per week from the 6th of April 2025. The average gross weekly, as we mentioned earlier, is changing. So to qualify for SSP and parental payments, that's going to increase to £125 or more per week. So another thing just to mention on statutory payments there, the statutory redundancy pay rate for the rest of the UK and Northern Ireland is expected to increase, but the new rate is usually announced sort of late March. So keep your eyes peeled for that announcement. And back over to Rebecca.
Thank you. Now for small employers relief. So small employers can now reclaim 108.5% of statutory parental pay. That's 100% of the statutory payment plus an additional 8.5% in compensation. Before it was 100% of the statutory payment plus 3% compensation. To qualify for small employers relief, your business must have had a gross national insurance bill of under £45,000, and that's in the full tax year before the worker's qualifying period for their parental leave. So that does mean, depending on the worker, you may be classed as a small employer for one worker, but classed as a normal standard employer for a different worker. Okay, let's talk about eligibility and entitlement for statutory neonatal care leave and pay. And for now, we're just talking about the leave element of it. So this new entitlement applies to birth, adoptive and intended parents in surrogacy arrangements who work in Great Britain, so not Northern Ireland. If an employee's baby requires neonatal care for 7 or more days within the first 28 days after the baby is born, the employee becomes eligible for neonatal care leave. It's really important to know that the leave can't start until after the first full week of neonatal care, and that's because the employee is accruing an entitlement at a rate of 1 week for each week that the baby is in care. So once that first week is passed, the employee continues to accrue leave up until the week after the baby is discharged, and up to a maximum of 12 weeks. Each parent receives their own entitlement, and the entitlement is based on the birth event rather than the number of babies. So even if they have twins, triplets, or more, the total leave is still 12 weeks per parent. Importantly, this neonatal care leave is in addition to any other statutory parental leave entitlements, such as maternity, adoption, shared parental, paternity, statutory parental bereavement leave as well. However, these leave types can't be taken at the same time. So, for example, you might have an employee who will take 52 weeks of maternity leave and then take another 12 weeks of neonatal care leave if they're eligible for it. Okay, let's break down how statutory neonatal care leave is structured. The leave is divided into 2 tiers. Tier 1 applies while the baby is in neonatal care and the first week after the baby has been discharged. During this time, they can take leave in weekly blocks, and they must notify their employer by the first day of absence or as soon as practicable. Tier 2 starts from the 2nd week after the baby is discharged and continues up to 68 weeks after birth. This portion of leave must be taken as one continuous block. In regards to notice, if an employee needs 1 week of leave, they must provide at least 2 weeks and 1 day of notice. If they need 2 or more weeks of leave, then the required notice is at least 4 weeks. Now let's talk about the payment for statutory neonatal care leave. To be eligible for statutory neonatal care pay, an employee must have been employed for at least 26 weeks before the qualifying week, and they must have earned above the lower earnings limit during the 8-week qualifying period, so similar to maternity pay, adoption, all of the other parental payments. During neonatal care leave, employees are paid at the statutory parental pay rate of £187.18 per week, or 90% of their average weekly earnings, whichever is lower. On the employer side, you can reclaim a lot of this payment back from HMRC. It's usually 92% if you're a regular employer, but if you qualify as a small employer, you can reclaim up to 108.5% of it. Okay, and now let's move on to some legislation changes that impact employer-provided benefits in kind. Okay, me again. First, let's talk about company car rates. So on the slide, we're using the term appropriate percentage, and this is the percentage that's used to calculate the taxable benefit of a company car. And the calculation is essentially just taking the total cost of the car, so that how much you would pay for the car, including all of its accessories, multiply it by the appropriate rate, and then you can prorate it depending on how long the employee has, the car has been available to the employee. For the 2025-2026 tax year, we have a straightforward 1% increase across the board on those appropriate rates, appropriate percentages. And those increases are going to be the same for the next 3 tax years. Although throughout those increases, the diesel supplement still remains at 4%, and the maximum rate is still 37%. So those cars with the higher CO2 emissions will still be capped at 37%. In future tax years, the increase is going to be much more significant. Starting in 2028-2029, the rate for electric vehicles will jump up by 2% each year. And for cars with emissions between 0 and 50 grams per kilometre, the rate will rise dramatically from 5% to 18% in 2028-2029, and then to 19% the year after. So for the 2025-2026 tax year, it's a straightforward 1% increase, but in the coming years, we'll see more significant increases for electric and low emission vehicles. It's a big change that could have a bigger impact further down the line, so it's important to be aware of it if you're planning on offering more company cars. Now let's review the updated benefit charges for the 2025-2026 tax year. For company vans, the taxable benefit charge is increased to £4,020 per year. And don't forget that this charge is divided equally between the number of employees who use the van. If the van is fully electric with 0 emissions, then the benefit cost remains at 0. In addition, the car fuel benefit charge has risen to £28,200, and this charge is calculated by multiplying the £28,200 by the appropriate percentage that we referred to before for the car. Similarly, the van fuel benefit charge has also gone up, this time to £769. The official rate of interest, which is used for calculating beneficial loans or employer-provided accommodation, is announced in April. However, from April 2025, in the autumn budget, the government announced that the rate will be reviewed each quarter rather than at the end of the year. This might mean that the already complicated calculations become much more complex. And lastly, as a reminder, the Class 1A rate on benefits in kind reported on a P11DB and the Class 1B rates on benefits in kind reported on a PAYE settlement agreement are both increasing to 15%. So it's going to make the costs of providing those benefits much higher. Just a note on that as well. Last month, our colleagues Akash and Larissa hosted a Power Hour on benefits. It's available to watch on demand, and I can see Annie's just posted a link for us if you want to take a look at that afterwards. And back over to Kay.
Thank you. So if anyone knows me, you know I love pensions. So I'm just going to mention the qualifying earnings for auto-enrollment as well. So for the 2025-2026 tax year, the pension earnings trigger remains at £10,000, and that is unchanged since 2014-15. It means workers earning above the threshold will continue to be automatically enrolled into a workplace pension. The qualifying earnings band also stays the same, with the lower limit frozen at £6,240 and the upper limit at £50,270. So it does maintain stability for employers and employees, but we have been waiting quite a long time for the removal of the lower earnings limit, which was legislated in 2023, but there's still no confirmed implementation date. So now, if you just want to drop your favourite song in the chat, Rebecca's going to sing a little medley for us. just checking you're all listening. We might do that if we've got time at the end.
Please ask us lots of questions so I don't have to sing. Okay, so before we move on, I want to take a quick poll to see how ready you're feeling for the upcoming tax year changes. So again, in the bottom right, you're looking for the option for polls. So you might need to click on apps first and then polls. So you have 4 options, either ready to conquer it, I've got this, mostly, I'm a little bit behind, or I'm feeling unprepared. So go ahead and cast your vote, and once we're done, we're going to share some tips to help you get organised. And if you're a PayFit user, we can reassure you that there isn't much left for you to do. And I can see Christopher's already suggested a song for us to sing at the end.
Looks like the poll results are pretty good. A few people who are feeling a little bit behind or not unprepared. You can re-watch this webinar afterwards.
As many times as you want.
Yeah, I think there's a lot to take in as well, isn't it? So I think it's always worth, you can go back, re-watch it, read up, to feel a lot more prepared.
It looks good though, I'm happy.
Yeah. So here are some key actions to get ahead of the April changes and keep payroll running smoothly. So update parental leave policies. So make sure your policies are going to include that statutory neonatal care leave and pay so that employees get the support that they're entitled to. Make sure that you review workers' pay. So make sure that your wages are meeting the new national minimum and living wages rates to stay compliant. Make sure you process any outstanding benefits. Check that your payroll software settings are ready for the new year with your any NI threshold changes. Most softwares will do that automatically, but it's still good just to check. And like I said, a few quick checks now is going to save you time and stress later on. And I'll see Rebecca there.
Thank you. Let's take a look at how PayFit simplifies moving from one tax year to the next. First, the app has automatic legislative updates, which means that all the latest changes from statutory neonatal care leave and pay to the new national minimum wage and NI thresholds, they're all available as soon as you open your April payroll. Next, our streamlined year-end processes take the headache out of the administrative tasks, so generating P60s or making final submissions. PayFit automates all of those tasks, so there's nothing for you to do. We also break down the complex calculations for you, from directors' national insurance to statutory sick pay. Everything is really clearly laid out so you can understand it and share it with your workers if they ask. Our real-time minimum wage checker is another great feature. It alerts you if any workers are being paid below the national minimum wage based on their age and their employment status, so including apprentices, to make sure your employees are all being paid fairly. And for workers on maternity leave, our updated maternity projections already show the new rates for the upcoming tax year, so you can send them an updated payment schedule now and share the good news with them. These features have all been designed to make your payroll processes smoother and more efficient, and of course keep you compliant. Before we move on to the Q&A section, we have some resources to share with you. Our marketing team has published some useful resources such as an end of tax year compliance checklist and a rate card, and we'll send those in a follow-up email after the webinar. I'm sorry, I'm just on the chat. We'll also post a couple of links in the chat now for some Help Centre articles that I've written to explain all of the changes we've covered today. I hope you'll find them useful. And let's move on to our Q&A. I just want to say Darren said it's going to be his 39th payroll year end. I think it's going to be my 14th. And even that feels like a lot.
That's a lot of payroll year ends.
Yes, congratulations, Darren. I think you might be more an expert than we are.
Definitely. You can join and host the next one.
Yeah, we'll get him up on stage.
So Rebecca, I think you've got a few pre-submitted questions that you're going to cover first of all, haven't you?
Yeah, thank you. Can you switch the slide?
Yes.
Thank you.
There we go.
Okay. Well, I'll take one of the pre-submitted questions and then I'll have a look at Christopher's. Okay, so one of the questions was if there's anything special we need to do with directors this year. So there's no real change this year compared to previous years. With all tax years, if the director pays their national insurance per pay period and not cumulatively, their national insurance will be recalculated in the final pay period of the tax year. So if their pay fluctuated significantly throughout the year, they might see an increase in their final national insurance payment, or they might even see a refund. That's perfectly normal though, and it's just to make sure that there's no difference overall between the two methods of calculating national insurance for directors. It's worth mentioning as well that before the start of the new tax year is the right time to have conversations with your directors about which national insurance calculation method is best for them. We do have a Help Centre article on our Help Centre that clearly explains the two methods that you could potentially send to them and check that they're using the best calculation. So Christopher asked, what's actually happening with P11Ds? Are they being phased out as planned or not? I've had conflicting reports. Sorry, I don't know if Akash was busy typing away to that. So from April 2026, HMRC, the government has announced that payrolling benefits will be mandated, but we know that there's still a lot left to do. So at the moment, for example, we have no way of payrolling employer-provided accommodation and no way of payrolling beneficial loans because they are annual calculations based on a percentage at the end of the tax year. So until we have a way of payrolling those benefits, we would never be able to fully switch away from P11Ds. We are curious to know if they will still go ahead and implement mandated payrolling benefits from April 2026 or not, considering we haven't had any guidance as software providers on how that will work. There's a few things that we don't have any information about, for example, paying Class 1A national insurance in real time, or is it still at the end of the year? There's a lot still to iron out. So we just have to keep an eye on the news and on the HMRC website to find out if it's still going to be mandated from April 2026. Let's see. Just checking the chat. I'm going to see if Akash is answering that one. I don't want him to be typing away and then I just answer it and he's like, oh, just delete my message. Kay, do you want to answer one of your pre-submitted questions?
Yeah, certainly. So we did touch on this, but we've got one. And we just want to say there's no stupid questions or simple, these questions that are too simple. Like it could be your first year end, it could be your 39th year end, like things change all the time. So please ask any questions that you've got. So we've got one here. I have an employee that left at the end of March. Can I give them a P60? No. P60s are only for employees who are employed at the end of the tax year, which is the 5th of April. They may ask, we do see that come up a lot. People will say, or even people who left mid-year will want a P60. They'll get a P45, which does include all of the year-to-date information that they need, which would be on the P60. So no, they would not get one.
Thank you. Akash has just answered that question. So another question we've been asked was one of our employees, too many babies. One of our employees has had a baby in March, and they've asked if we can backdate statutory neonatal care pay for them. So unfortunately, statutory neonatal care pay is only applicable to babies born on or after 6th of April. Sorry. Although it's a statutory entitlement, if your company plans to offer an occupational scheme, they could still implement that, but it means that you can't reclaim any of the payment of the statutory neonatal care pay from HMRC.
And I've got one more as well I can cover. So if our payroll benefits, do I need to do anything at tax year end? So although you don't need to submit individual P11Ds, you'd still need to submit a P11D-B to report and pay your Class 1A national insurance on the total taxable benefits. And the deadline for that is the 6th of July. So you still have something to do there. And I'm just going to look in the chat. I don't think we've got any more questions in there. I'm just going to scroll back and see if we've missed anything.
Mm-hmm.
I think we have covered them all. Yeah, I think. Yes, Polly, I know Akash has answered there. What happens to P60s if you reopen payroll, make adjustments? They would be reissued, so it would make sure that the correct year dates are shown on there. Yeah, we've covered Scottish tax. So I see someone's typing, so we'll just give it a minute to see if anyone's got any other questions. Thanks, Christopher. Yeah, hopefully you guys have found this useful. And like we said, you can go back and watch it again if you need to. If you are a PayFit customer as well, feel free to reach out to us. We've got a fantastic help centre as well there. Debbie's got a question there. Can I check is SSP from day one in April? Rebecca,
Can we take that?
Yeah, thank you.
Yeah, the new statutory sick pay rate is applicable from the 6th of April. The government has confirmed that they are going to go ahead with the removing waiting days from the statutory sick pay. So I'm not sure if you're referring to that, but that won't happen from April 2026. I don't know if it will be April 2027 or even later, but that is good news. I don't know if other people have heard that they're removing waiting days, so employees will be paid from day one of their sickness. And they are also removing the threshold for employees to be eligible for statutory sick pay. So as long as the employees have had some form of earnings in the last 8 weeks before they went on sick leave, they'll get 80% of their average weekly earnings as statutory sick pay. So it makes a lot more workers eligible for statutory sick pay, which is good news. There will still, of course, be the cap of the statutory sick pay rate, though. So anybody who's already eligible for statutory sick pay will continue to just be paid that rate. But good news for people processing payroll at least. Yeah. Maybe not so much for businesses. I think businesses are being hit a lot at the moment with the extra costs.
Yeah. But that's not from this year, though, just to...
No, yeah, sorry, I didn't want to confuse people. I just thought it was interesting.
It is, isn't it? So I guess we'll leave it there. So thank you so much, everyone, for joining. Like I said, if you still have questions and you are a PayFit customer, please reach out to us. We're all here to help. But yeah, thank you so much for joining.
Thank you very much. Bye, everybody.
Bye.